Actually on here. Woohoo! So even though I am a little bit Facebook challenged and tech challenged, I've made it on here tonight for you people, my people. How y'all doing today? This is session 3 of Path to Home Ownership, our home buying course. And actually here, let me turn off my ringer. So I'll make sure that, there we go, that I'm good. All right, so when you guys come on, we'll be all set and ready to go. I just wanted to go ahead and get everything started. We're on time. Tonight, we are going to be talking about being a savvy buyer. And I'm going to give you guys a lot of good information. So tonight, we're going to discuss some of the acronyms, what I call the lending lingo. Because a lot of times you hear these different things, this is short for that or whatever, and you may not know what all of that stuff means. So I wanted to talk about it today to give you some insight as to what these things mean. And then also we're going to talk about something that's extremely important, mortgage money. So we are talking about the money today. Where does it come from? How much do you need to have? What are some estimates that we can think of, things we want to anticipate when we get into the mortgage process? And I have all that for you today. So let's see. Share screen. Should be able to do this. Okay, I think if we just do the entire screen, that should be sufficient, right? Okay. All right, it says I'm sharing my screen, but okay, yeah, you don't want to see that. Let's go to something else. So I can't really see probably the same way that you guys see. So we'll just go with this and I'll figure it out later as to how this actually looks to everybody. But okay, so you already know this part, path to home ownership. And just a reminder for who we are. We are the 23s. So welcome back, everybody. All my 23s out there for coming in, tuning in live, participating, and for staying focused and also for staying on the path, because we want to make sure we are doing that. All right. So there we go. All right. So as I mentioned already, this is what we're going to be talking about today. And I'm trying to make sure I'm on here too. So I'm keeping up with everything because I don't want to miss anything, because you guys have like really, really good questions. And so I want to be sure that I'm following along. If anything comes up that you have questions, comments, or concerns about, then we want to talk about that. All right. Talking about the money today. Okay. Here we go. Okay. All right. So going on to the next slide, we're going to jump right in. So lending lingo. There's probably a few of you guys that have heard on about some of this stuff. UR, DPA, AUS, LTV, LP, CLTV, HOI, EM, DU, DTI, LOX. What does all this stuff mean? So we're going to go through a few of these just to kind of get everything started. So anybody have an idea what any of these mean? You can throw something out there if you want to in the chat. Just type it in, what you think it might mean. Like, for example, let's start with this one. Everybody should have heard this at least once. DTI. Any idea what DTI means? If you have an idea, or if you just want to guess at it, there's no wrong answer as far as, guessing. It is a wrong answer, because it do stand for something. But if you want to guess at it, feel free to guess. Even if you don't get it right, we'll make sure you get it right before we leave. So anybody know what DTI is? DTI. I'm gonna give you a hint. Anytime you see a D, anytime you see a T, it probably stands for two. So it's something to something else. And it's basically what we use to calculate a couple of different things, some ratios that I have to work with for the loans that I do. Because we do look at numbers. We don't want, too much debt to be on your plate when you're looking at doing your monthly payments and things like that. So that is one of the things we do. We calculate Hey, Autumn Brown got it. Paul Harris got it. That's right. Debt to income ratio. Exactly. So that's what it is. And it's really the way they taught it to me when I first learned about lending like 16, 17 years ago was that it's the debt to income, which means debt divided by income. And that's actually how you figure it out. So it's a real simple math problem. Okay, so let's do another one with T. And how about LTV? Anybody know what that one is? LTV. You already know the T stands for two because I kind of gave that one away. And this is another ratio that we have to figure out. And it actually has to do with the house itself, not your debt, but it has to do with the money surrounding the house itself. So if you think about the house has a value, right? So we do a ratio that has something to do with the value. Let's see if anybody can figure it out. LTV. That's close, Monica. You jumped right in there, I see. So LTV actually stands for loan to value. And what that really has to do with is the value of the house compared to how much of a loan that you have on the house. So we do like for example, for FHA, normally I do a 96.5% loan to value. And that means that if the value of the house is say $100,000, that the loan to value is going to be 96,500, 96.5% of that $100,000, because that's helping us determine how much of the house you actually have a loan for. Make sense? Couple more. Let's do a couple more. HOI. That's one we do a lot. Yeah, thank you, Monica. HOI. Anybody know what HOI mean? HOI. You could probably guess that the H stands for what we're all here to talk about, right? Home. So home something something. Any guesses? Let's see. Anybody got a guess for HOI? You have to get it because it protects your home. So anybody know what HOI might stand for? Great, Monica. I'm gonna have to start giving out prizes. Good job, Monica. Yes, homeowners insurance. Exactly. So that's what HOI stands for. Now, here's one you don't always hear, but we should always want to know a little bit about. DPA. D like dog, P like Peter, A like apple. DPA. Anybody know what that one stands for? And I'm actually going to talk about that tonight. We're going to talk about that a little bit tonight near the end of our presentation today. So DPA, any guess? I'll give you a hint because I like to give hints. So I'll give you a hint. DPA actually has to do with the money for the house, not the money into the house, but the money that you need to buy the house. So DPA, anybody got an idea of what that might stand for? I'll give you one more hint. So A stands for assistance. Any guesses? Let me see. We got anybody that's willing to guess on that one? Paul, you own it today. That's my bro right there. What's up, Paul? Exactly. That's it. Down payment assistance. That's what we usually refer to as DPA because, saying down payment assistance, that's a mouthful right there. So, all right. So I think I'm going to leave this alone. Some more we may talk about, but maybe near the end if I have enough time. There are a few more that I'd like to share with you guys. Just so you know what they mean, because a lot of times we throw around these lingo things, these acronyms and stuff like that. People don't know what that means. So I want to make sure you guys are educated and you understand. So when somebody says, well, my DTI is high, you say you need to pay down some debt because you understand what it means. All right. So moving right along. Let's see. I want to jump right into, it's not moving my, that's weird. It should have moved me to the next slide. So I want to jump right into actually looking at a loan estimate. So that's what we're going to be talking about tonight. There's a couple of different, this is something else we actually could use an acronym for. LE stands for loan estimate and CD stands for closing disclosure. You guys get both in the context of your transaction. So there we go. All right. I don't know why it took so long to move it. Okay. So we're going to look at a fake loan estimate today. And then after that, we're going to look at a fake closing disclosure. I'm not using real people's information. So here in the loan estimate, this basically is what you get when you first get your disclosure package to sign all of those papers when you have applied for the loan. For those who are buying, this is the point at which you had your contract, you got an offer accepted, you have a contract now, and you have officially applied for the loan. Remember, everything else is like pre-approval, pre-qualification, stuff like that. It's not pre anymore. Now we actually in it. So loan estimate is something that you're going to get. And there's a couple of different things, just some basic information. You can see this on there. It talks about like the date that they actually prepared it, the name of the person, who are the buyers, the property that you're buying, the subject property, how much you're buying it for. And then it talks a little bit about your actual loan. So on this case, we're doing the 30-year fixed for purchase. It's a fixed rate product. It says it right there. And it tells you what kind of loan it is, conventional, FHA, or VA. In this case, we're going with conventional, although I'm going to talk about FHA as well, because a lot of my customers do qualify for and get more benefit out of FHA loans. So it tells you if the rate is locked or if it's floating. So right here is where it says rate lock. Then you have no or yes, and they check that box as well. So it gives you the loan amount. Now keep in mind something, because this often comes up as a question. The sales price is 180, but the loan amount is 162. Why is that? Because everybody has to put money into the loan. So we don't finance it 100% unless it's something like a USDA loan. We can do those in 100%. Or if it's a VA loan, then we can do those in 100% as well, because those products are designed that way. But when you're looking at FHA, conventional, you got to have some skin in the game. So normally for FHA is 3.5% down, and normally for conventional is between 3 and 5% down, depending, because there are special programs for people in certain income brackets for conventional that you can actually do 3% down instead of 5% down. So anyway, that's what this is. So this is the actual loan amount, the difference between your sales price, the amount you agreed to buy the home for, and the amount that you put down. That's what the loan amount is. This tells the interest rate. Ooh, I miss these days. 3.875. Lord Jesus, that was a long time ago. And then this tells you what the principal and interest is. So see how we got all these no's? It's letting you know that these things don't change. That's really important to know. Okay. Something else that we don't do. Does the loan have these features? Prepayment penalty. This one says yes. For me, it's going to say no, because we don't have prepayment penalty products. I won't say it's unheard of, because for certain types of loans, you can get that. But for what we'll be doing as you buying a home, to live in, or buying a home to invest in, then the likelihood of you having a prepayment penalty is definitely not on the FHA or conventional. No, they won't do it. And then balloon payment. No, that means a balloon payment is like, if you get to a certain point, like say 20 years into the loan, and then whatever money is left over, it's all due at one time. So let's see. Okay, this seems to have kind of twice, so I don't need that. All right, let's see what else we got. Okay, so now this this is important. Projected payments. Now, what's different on this one, because this is conventional, is it's going to tell you, it's going to do an estimate for when your PMI would fall off. That's another one I could have put on there, actually, PMI. I don't know if anybody knows what that one means. Anybody know what PMI stands for? Because that's actually coming up here. See, we had PMI years 1 through 7, but if you notice years 8 through 30, PMI is not there. Why is that? Because on a conventional loan, once you get to a certain percentage of the LTV, that loan to value, once you get to 78% on your loan to value, exactly. Thank you, Paul. Private mortgage insurance. I got you. Once you get to that point, your private mortgage insurance, or your PMI, will fall off. So they're estimating that by year 8, that would have they would have reached that 78% on the LTV, and so no longer will have PMI. So actually, on this example, that loan monthly payment will decrease, so by $82. So it's important to look at this part of your loan estimate and your closing disclosure. Now, this actually talks about your taxes. So everybody, we all, until you die, you're going to be paying taxes, insurance, and stuff like that. So mortgage is no different. So here, your taxes is showing what those are, and the homeowner's insurance. It just lumps them together all as one sum, so you have it all at one time. Let's see. And then here, anybody ever heard the term escrow before? You know what escrow is? Yeah, I have some pretty educated people already. Y'all answering a lot of questions. You know this stuff already. But escrow. So escrow is it's called an escrow account, and it's the account that the lender will put your money in to collect and pay your property taxes, and your homeowner's insurance. So like if you notice right here, it says property taxes. The question is in escrow and it says yes. Homeowner's insurance in escrow and also says yes. And then here, I don't know if it can let me, my sharing thing. I don't know if I can move this. Oh, I can. Okay, I'm learning some stuff. All right, so let me go back up. All right, so here it's telling you your estimated closing costs at 8,054, and then it's also telling your estimated cash to close 16,054 on this example. All right. Now, I did want to go over this one a little bit kind of quickly, but I do still want to definitely go over it. So, this is the breakdown of the different costs and fees that are a part of the loan. So this is really, really, really important. And this loan in particular is kind of small. I'm not sure how well you guys can see it. It is a little bit small, but here you'll see origination charges. This is where your lender fees are. So for me, I'm the lender, I'm the broker. So I put you in contact with a lender and then we place your loan there. So or you have origination charges and it shows exactly, there's nothing hidden. There's, people can't say that they didn't know unless they just didn't read, because we put everything out there. All the information that you need to know is there. It's available. If you're not sure, you don't understand it, then you have every right to ask questions. Not every lender is like me that, takes the time to really explain a lot of these things in great detail, but it's also up to you. And I would just encourage you and admonish you, if you're not sure, you ask the question, because you can't get mad for somebody not giving you the answer to a question that you did not ask. So this is what we charge as the lender, as the broker. So these are the fees that would be, in conjunction with that. I don't charge an application fee. I guess this person who was with Ficus Bank, I guess they did charge one. So there's an app fee on here and then an underwriting fee. Underwriting fees are not uncommon. You will see those sometimes. And in this case, in order for these people to get their particular rate, that 3.875% interest rate, they had to pay a little bit of money. It was only a 0.25%, but they had to pay $405 in order to be able to get that rate. So what's funny is that sometimes right there, it'll say discount points. You think of discounts as being something where you're getting something off. That's not really how it works. So the discount point really means that it's a fee that's being charged in order for you to get a lower rate. So those are your lender fees. This is kind of a combination. It's also a little bit of title fees too. So you kind of got both going on right here. But these will come off. So like the appraisal fee, normally you pay that up front. For me, with your credit report fee, I also have you pay that up front. And then these other fees are more like title stuff, flood fee, the monitoring, the tax monitoring fee, all that kind of stuff. They have you pay that. And then everything down here is what the title company charges. So I don't know if you guys really know what the title company does, but essentially the title company is designed to kind of be like the intermediary between all the different parties. So the title company, even though I'm the one responsible for securing the money, the lender is responsible for providing the money. The title company is responsible for counting the money and making sure that the right amounts of money get to the correct people. So for example, like this is what we're going over right now. This will say how much the buyer has to bring to closing. It's an estimate right now. It's just a loan estimate, but it'll say what the buyer has to bring to closing. And then you'll also have, like, say, for example, when you get to the closing disclosure, you have real estate agents that, they're like me, they're salespeople, so they get paid upon the consummation of the loan. So when the loan closes, then they need to get paid. So the title company writes out a check for whatever their commission is to their brokerages and stuff like that. So all of their fees for what they do, they also do, they do examinations. So I should share this story. So I'm gonna share this real quick because it's it really impacted me when I saw it, when this lady brought this information up to me. So I met a lady who I was doing a loan for in relocation before. She told me a story about her grandmother. Her grandmother had bought this house, and like way back in the day, her grandmother had bought the house. Grandmother passed away and left the house to the daughter, I think it was. The daughter was living in the house one day, gets a knock at the door, and this lady's like, you guys are going to need to move. This is actually legally my home, and I'm going to move into this house. And she's like, no, it's not. This is my grandma's house. She left it to me, blah, blah, blah. Well, it turns out that there was a mistake on the title work. to the home. So that other person who came knocking on the door actually really did have the legal right and ownership of that home because of the mistake on title. It happened years ago, and I guess she found out about it later, and so she went back to claim her property. And unfortunately, the daughter had to move. She had to go find someplace else to stay. And then because she didn't have title insurance, there was nothing that she could do about it. She didn't get any kind of reimbursement or anything like that. There was nothing she could do to recoup any, money for her staying there, for having to go someplace else and start her life over and everything. She had no remedy for it because she did not have title insurance. So why am I saying that? Because your owner's title policy is extremely important. Not to say that that's an everyday thing that happens, but heaven forbid that you would be that one that it would happen to. You know what I mean? Nobody wants to experience that. So, and that's just something that a customer has shared with me. That's not anything that I experienced myself, but just by knowing that stuff like that really can happen, from that point on, I took title insurance much, much more seriously, and I recommend it because you don't have to do it. It's not a requirement. But if you don't, then you do run the risk that if something were to happen, if there was a mistake, then you wouldn't really have any kind of recourse to be able to fix that. So title companies are very important. These are the fees that they charge for what they do. So let's go up here. So for all of you all people that's in Crook County, this is where they charge a lot of their fees. So taxes, government fees, you're going to see here. This one actually doesn't show what we normally would see, but transfer taxes typically in Cook County are probably about maybe $2,500 to $3,000. And I really don't even know what that gets you, to be honest. You'd have to ask somebody over at the county if they could tell you. So, when I pay that $2,500 when I close on my house, what exactly does that allow you guys to do? Because I don't know. But but it is something, that we don't have any control over. They're the government. They charge it. It's a fee that goes to the county. And it's going to come up on your closing disclosure. So now this is what we were talking about a little bit earlier when I was saying about how there is an escrow account. Excuse me, I'm sorry. Let's go to prepaids first. So this is what I was talking. This here is for escrow account. So we'll come back to that in a minute. But this is for that lag of time in between when you close on the house and when you actually are going to start to make your first payment. So like, let's just say that, like, I have somebody closing tomorrow. When they close on the loan tomorrow, they don't actually make a payment until April. April 1st is when their first mortgage payment is going to be due. So that means for the month of March, there's no payment. But also for the month of for the month of February, which we're finishing out, there are fees that would really actually be due for the interest. They compound it daily. So you'll see that here: prepaid interest, homeowners insurance. You'll see all that kind of stuff that's already taken care of. So that way, all of your fees and costs are already worked in. So you get that breather to not have to worry about paying those additional costs for that other month. So, but it is taken care of. It's taken care of right here. Get to the escrow account. So I didn't really see anybody else had any comments or if they really understood escrow. If you guys got questions, go ahead and put them in the chat. But an escrow account, as I mentioned earlier, is where they house your homeowners insurance funds and also your property taxes. So they put it in an account so you don't have to worry about paying it. It sits in that account until it's due. Once it's due, then now we as the lender will make that payment on your behalf. We send a check to the county for your taxes. We send a check to the homeowners insurance agency for your homeowners insurance. So we handle making sure it gets paid. All right, so let me see what else we have here. Now, this is the fun part. This is where we actually calculate the cash to close. So obviously, there's a lot of fees on there. So if you notice, we would get to these different points and they would say, total cost between these $56.72, and then here $23.82, and then the total cost is $80.54, blah, 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 blah. So we got the total loan cost, closing cost of $80.54. The down payment funds that are required from the buyer, 18 grand. They made a deposit of 10 grand. So you notice a sign in front of that 10,000. So they're actually taking it off and making it more like a credit. So you see that there. And this is how you can, like I said, nothing is hidden. So you can see how they're calculating out what your money is that you're bringing to closing. All right, hold on 1 second. There we go. Now, this is a not so much fun part. This is going to talk about the total interest. This blew my mind the first time I saw this on a HUD statement. But the total interest that you pay over the course of the 30 years is actually 69.45%. That's a lot. So my suggestion would be that if there's a way for you to, pay off your mortgage sooner, and we can talk about that. That's one of the things that I think is a really good a strategy to use just for wealth management and things like that. But yeah, you actually end up paying a lot of interest over the course of the entire loan. That's over the course of 30 years. Keep that in mind. Annual percentage rate we have here as well. And then they just let you know how much principal you pay off. So the thing about mortgages is that they're actually, the way they are amortized is that they're interest heavy at the very beginning. So when you, like, say, for example, let's just say I have $1,000 payment for my mortgage, probably about maybe 600 of that, maybe 550 is going to go to interest. And then the rest of it, maybe 150 might go to principal. And then, the rest of it would be, reserved for the homeowner's insurance and the PMI and the taxes. But if you really look at the numbers, the majority of the payment is going toward that interest. So this is explaining to you that, in 5 years, you will only have paid off $15,000 of principal, even though you would have made payments equivalent to $56,000. So again, nothing is hidden. They're letting you know that right up front, that that's how it works. And then this is just where you would sign. And so sometimes people have questions about this. Signing in this instance does not mean that, one, you're in agreement, one, that these numbers are accurate, or that you are saying, oh yeah, this is what we're going with, I'm going to do this. If you read this at the bottom, it says, by signing, you are only confirming that you have received this form. You do not have to accept this loan because you have signed or received this form. So that's something I want people to know and understand, because sometimes when people, like I had a CD go out to a lady today, and I called, it says, listen, I'm letting you know now, I need you to sign this document to acknowledge that you have received it. However, that $30,000 that is saying that you're supposed to bring to closing is not accurate. Once the fees are, remedied and everything is balanced out, and once we have the credits put onto the file, then the numbers would be what we already previously talked about. But sometimes that can be a little scary, because like, man, I got to bring out this money, then you don't want to sign it. But that's not how it works. You only sign in acknowledgement. So you have to sign it, because if you don't sign it, then some of the things that need to happen next cannot happen. So you do have to sign to acknowledge. But I want to make sure you understand that you're signing just to say that you've received it. Okay, let's go to the next thing. Closing disclosure. So I know you guys are in the chat. If you have anything that you want to say, ask, bring up, rumors you about any of this stuff, feel free. Welcome. I am watching it, so I can't see exactly what's going on. So if you have any questions or any comments, go ahead and throw them in the chat, and I'll address them as I'm going through the presentation. So a closing disclosure and a loan estimate are very, very, very similar. I'm going to show you. You're going to think I'm going over loan estimate all over again, but I'm not. It's a closing disclosure, and it's a little bit different because now we get into not only all the costs and fees of the loan, but we also get into the credits, and we get into who gets paid what. So let's move right along. As you can see, this one, it starts off pretty much the same as how we were with the loan estimate. So this part doesn't really change that much. It's still, the loan amount, the interest rate, the principal and interest, and it asks you, does the loan have these weird features, which, you already know that I don't do loans like that. So no, we don't have a prepayment penalty. No, we don't have a balloon payment. We're not doing any of that. All right. And then it also talks about the projected payments, same thing as what it was on the loan estimate. And again, at the bottom, closing costs and cash to close. Now, here's where it's going to vary and be a little different. So this in the closing cost details does look different than what we saw on the loan estimate. So for example, it's telling us things that have already been paid. For example, let's go down to B, because there's really nothing already paid in section A, but in B there is. Because remember, I mentioned that the appraisal gets paid up front because that's a third party person, so they gets paid outside of closing. So if you notice here, instead of this being in this column where it was in a loan estimate, now it's over here. because it was already paid outside of closing. So technically, it's not a charge. It's really more like a credit. So we credit this, we credit that. These still haven't been paid yet. These are all title fees, so they haven't been paid yet. And then let's go here. This is also the taxes for Crook County. And so on this one, this isn't for Cook County. The example is not, so you can't see it, but you would have those transfer stamps that I talked about. Probably on the average, I see probably about 2,500, 22 to 2,500 ish for a single family home. So you would see that there, and those get paid at closing. So instead of this being like only the 60 bucks, that's usually about 98 because it's 40, I think it's 45, 40 something. But I think it's total 98 usually there and about 2,200 for transfer stamps. So you will see that. And then this part is still the same. Go to the next one. Now, this part you will only see if you have items to pay at closing. I do have somebody right now where I have her paying off about, I want to say maybe seven, maybe 8 different items. So she's got some revolving debts, some installment loans, things like that. It's about 7 or 8 different items that in order to make her loan work, I had to have her pay them off at closing. So here is where you would see something like that. It's not $115,000, obviously, for her. It's about 8. But in any rate, this is where you would see that itemized, that there's going to be things that you have to pay off at closing. This is only if you have to pay stuff off at closing. That's not the case in most loans. Most of the loans I do, we don't have to do that. We usually figure out other ways, to make the DTI work and stuff like that. But it's an option. If you have the money, you're able to do it. And that's something that we want to do. And the good thing about it is once you do it, then you don't have that debt anymore because now you just wipe that out. So yay you. All right. And so a couple things more. So now we have where we estimate what your cash to close would be. This is always a very big question for everybody. What I need to closing? What I need to closing? What I need to closing? So this is where we estimate that. So like right here, this is the final one. So you got the loan amount, the closing costs, the closing costs paid before closing. So remember when we showed the appraisal and it was something else. Oh, the credit report, I think. We showed those 2 things as being paid outside of closing. So that carries down here. You'll see that come here. Also in the state of Illinois, this is a really cool thing. In the state of Illinois, the owner's title policy that I talked about that I said is so important is actually not paid for by you. It's covered by the seller. So I think up above, it was like about $1,900 that it said that was going to cost. So that actually gets moved over to the seller side. So they're the ones that pay for that policy for you. So you don't even have to come out of pocket for that one. All right. And so then we, do these numbers. This obviously is hold on a second. No, this one's not. Payoffs. So you're subtracting, adding, until you end up coming up with the bottom line number. So sometimes people ask, well, what happens to my earnest money? They didn't show it here on this one, but normally on your closing disclosure, you will see your earnest money here. It'll be called a deposit. And it'll show here on its own line. So like if you put down $1,000, $2,000 for earnest money, that will show here. So you can see that we included it as part of what your credits are. All right, we are almost done. And then this is the same thing as like what was on with the loan estimate, where it talks about the total finance charge, what you finance, what the total interest is over 30 years, how many total payments you make, and what those come to as a dollar amount. That's shown up here. And then it just gives information about a couple of other things. This is all stuff you can really just kind of read on your own. But I did just want to point out, again, for transparency, all of this information is here and available to and for you. We have all this information. So if you ever have questions, feel free to pose those questions. All right. So it also tells you who's involved in your transaction. My information would be here because I'm a mortgage broker, but the settlement agent actually is either the title company or like a sub of the title company. They're the ones, that handle the actual financial parts. Remember I told you at the title company, they're the ones that disperse checks and things like that. So now you actually get to see who is responsible for that. And again, confirming receipt. You have to know who did what, and you have to acknowledge. So where do I get these funds from? Where's all this money supposed to come from? I need somebody to show me the money. All right. So I want to talk about a couple of different things as far as that goes. There's a different, so you have to think in terms of a transaction for a mortgage as there's a lot of rules. Like literally, if you went to look up FHA rules and regulations, the guidelines, if you went online, you would find a 1,035, I think, page document that has all the rules that govern FHA loans. I have not read all 1,000 pages, but it is, something that has a lot of information in it. So where do the funds come from? It has to be something that is allowable by whatever type of transaction that you're doing. Purchase, may have different restrictions than refinance. Conventional may have different restrictions in FHA, USDA, or VA. Government loans are always different from conventional. So you can get funds from your Uncle Ramus, like, hey, you're doing real good at that restaurant over there. Why don't you give me a little bit of money? So he can give you a gift up to 6% of your sales price. So think about that. If you bought a house for $100,000, that's $6,000 you can get a gift for if you got it. So that's one thing that you can do as far as being able to get the funds, to help you so that what you have to bring to closing is not as much. Another thing that can happen, and a lot of the realtors that I work with are really good about this, they will negotiate out a credit for you so that the seller can help by crediting the money at closing. The way that'll work is it's dollar for dollar. So let's just say that the seller was crediting $5,000 for you, and say your closing costs and your cash to close came out to, I don't know, $10,000. And the seller said, well, I'll contribute and I'll do a seller credit of $5,000. Well, now your cash to close just became $5,000 instead. So that's all you have to spend at closing. That's what you're writing your check out for. Then it's also something else that we kind of touched on just a little bit earlier when we were going over our different acronyms. Down payment assistance, and that will contribute towards your total cost. Move that out the way. That would contribute towards your total cost for the loan. Now, down payment assistance programs can work in a couple of different ways. So we have programs where they are really actually grants. So a grant then would be, let me see if I can get rid of this because I don't really need this up anymore. A grant would actually be something where it's more like they give the funds at closing, and then after they give those funds, you don't have to pay it back. So that could work in a couple of different ways. One of the ways it could work is they literally just forgive it the day of closing. Once you close on the loan, that's it. You don't owe anything. You won't hear anything else from whoever, whatever company it was that gifted those funds. You're done. It's all over. Another way it could be a grant is actually more like a second lien on your house, but it's forgivable. So what that means, you still have to meet these specific requirements. So they'll put a second lien on your house, but when they put that second lien on your house, what's going to happen is every month, a prorated amount is going to be forgiven. Like say, for example, you got a grant that was $10,000 and it's going to be on your second mortgage for, I don't know, 5 years. So every month for those 5 years, there'll be a prorated amount. It might be $125.36. I don't know, but it'll be forgiven every month. Now, the tricky part with that is if you refinance before those 5 years is up, there may still be a part of that grants that you owe, and it will be part of your payoff in order for you to refinance. So that's something to keep in mind that can happen. The other thing that can happen is the program is not actually a grant. It's really more like a loan. So they do give you a secondary lien on your house. And then from that secondary lien, you actually have a secondary payment, a smaller payment. So you have your regular mortgage payment, your first, and then you also have a second that you pay until you pay that off and, recoup all those funds back to the entity that provided them at closing. So let me see. Do we have any questions? Okay. It doesn't look like we have any questions right now, and we're at 6:40, so I know I probably went just a little bit over. Sorry, but we got about 5 minutes left. So if there is a question that you have, then you can feel free to ask those right now. Type them in the chat. You know what, guys? I got to figure out a way that we can talk to each other, because I'm a church girl, and I'm used to y'all talk back to me. But I can't hear nobody. I can't hear nobody talking. I do see you typing in stuff though, so that's good. That helps. But I can't hear nobody talking. It's not the same. So anything that you have questions about, you want to bring up right now, we can definitely address them right now. I did this for you guys, but I don't have a way to utilize it. So I'm just gonna show it to you if I can. Let me see. How about if I ask you a couple of questions while you're thinking about your questions? There was one more that we didn't do. LOX. Did anybody have an idea what an LOX is? So this was a little bit tricky because the X is actually not the first letter in the word. It's really just us being lazy. It stands for explanation, but LOX does actually stand for something in lending. So does anybody have an idea what that might be? LOX. Ends in explanation. Do I need to put on the music, the guessing music? Audible only. Oh, you couldn't see on the closing sheet? Okay. I'll have to check into that. So LOX stands for letter of explanation. And sometimes we need that because, stuff in life happen. It might be something with your credit. If you do have a bankruptcy, you can count on it. We're going to ask you for a letter of explanation because we need to know what happened. Why did you file a bankruptcy? We need to know what has been different since that's happened. And, prayerfully, after the bankruptcy, you have reestablished yourself and now you're doing a better job and you don't anticipate having to, to file a bankruptcy again. So we would require a letter of explanation for something like that. Any other questions? Looks like we're good. DU is another one you guys might hear. I usually talk to people about this one because it's part of the analysis that we do on a loan file. DU stands for desktop underwriting. I'm gonna just give you that one because you would never guess that one, so I'll just give it to you. So DU stands for desktop underwriting, and basically what it is, it's one of the things that we use to analyze the loan file for Fannie Mae. If it's LP, if it's going to be for Freddie Mac, but for Fannie Mae, and we do a lot of Fannie Mae loans, DU is what we use, and it gives us like a vision of how an underwriter will look at the file. And so once we get DU findings, and we can use those findings to say, hey, I know what an underwriter is going to ask for. I know what the underwriter is going to be looking at. I know what's acceptable and not acceptable. And so we can use those findings. Kind of generally, there are going to be some specific things that might be exceptions, to whatever our situation is for our particular customer. But typically your DU findings give you a very, very good almost like a rudder, for the ship that you sail in, as to how things should work and what it is that you need to do. So, yep, I got letter of explanation, got no more questions. All right, perfect. So next week we got my main squeeze, Dion Branch, coming in. She's one of the realtors. She has Allure Dream Homes and has built a wonderful team and reputation for herself as a realtor extraordinaire. And she will be teaching next week. So she's going to talk about the process of, from the realtor side. She's going to talk about the process of actually, going out and looking for the homes, how you get set up with the MLS so you can start to see things that you need to think about for the physical property, the neighborhood and stuff like that. She'll talk about all those different kind of things to kind of walk you through what that would be like. So don't miss it. We'll be right back here, same bat time, same bat station, and we'll be waiting to see you guys. Thank you so much. Everybody have a good night.